Welcome to Short View Trading. It's your morning market hit for Monday, 23rd of January. It's around 9 a.m. London time. What we want to focus on in this video is what matters for those who want to trade equity index futures on a 1 to 2 week swing basis. So let's dig in. Well, what a week that was. Quite an extraordinary week. A shortened week because of the Martin Luther King holiday on Monday, so shortened in the States. But yet 3 consecutive down days in the S&P 500, Tuesday, Wednesday, Thursday, as you can see on the chart in front of you now, before a sudden, sharp and quite punchy reversal on Friday. But Friday was strong, but it didn't, of course, retrace all those losses. Here we have the S&P 500, as you can see on the chart in front of you now, knocking on the door of its 200-day moving average, trying to push through that key resistance line that's been in place really since the start of this bear market early last year. And with that performance last week, we saw most US equity indices were flat or slightly down. The Dow Jones particularly poor, and the Nasdaq 100, the exception, actually up on the week, asking and pushing and creating and generating that question, is rotation underway within sectors in the States, away from the stuff that's performed well into the stuff that's performed poorly over the last year, the tech and the Nasdaq 100. It's also interesting to note that that happened during an earnings week, the first full week of earnings from the S&P 500 companies. Fourth quarter earnings in aggregate, they're surprising to the upside by about 4%, so broadly in line on that metric as to where you'd expect them to be. But despite that, the market not really doing much over the course of last week, and even a little bit soggy. In Europe too, it was also pretty weak last week, with softness largely across the board, except for 1 or 2 country indices, as you can see in the chart in front of you now. So it leads to the question, are markets rolling? Are they rolling over from the strong bear market rally? Or should we believe the mood in Davos last week, which was pretty well characterized by Larry Summers, who talked about hope rarely triumphing over experience, but perhaps this is one of the times when it will do so. Is Davos man correct? Should we be more optimistic? Should we listen to the German Chancellor, who says he's confident, sure in quotation marks, that Germany won't be in a recession this year? Or is it actually that markets are rolling over, they're back at key resistance levels? Well, from a 1 to 2 week market trader perspective, a swing trader's perspective, the models are what count the most, and the models are back on sell. The short-term models hitting sell signals largely across the board last week, at the start of last week, and the medium-term models as well. And indeed, momentum looks as though it's rolled over, as you can see from this global composite momentum model we're putting up in front of you now, rolling over in the last few trading sessions and heading south downwards. And added to that, medium-term models are increasingly back on sell. See medium-term RAG 1 and RAG 2 we're putting up in front of you now. Model's been great at picking up the swing moves in this bear market, the local highs and local lows. And on top of all that, our sell-off indicator, which is designed to forecast waves of risk aversion, is marching towards its key +20 level, reaching +15 overnight. As you can see in the chart in front of you now, it's given quite nice signals at the top of local highs in this bear market, at the top of bear market rallies at local highs over recent months. So it's going to be a really interesting week. There's a lot to focus on: price action, market technicals, as well as our models, on top of which there's a lot of macro and earnings events over the course of this week. So to keep on top of it all, to watch that sell-off indicator continue to build towards +20, to see all our other models and to see our daily updated commentary on markets, please do take a free trial of the Daily Rag. Simply click on the link below, put in your name and email address, and we'll send you the Daily Rag for free for a bunch of weeks. So if you're a subscriber already, fantastic. You should have the email in your inbox every morning early. So what are we watching this week? Well, there's a ton of stuff going on. Of course, it is China New Year holidays, so Asia's quieter this week. And it's also the case that it's the blackout period for the Fed governors, because the meeting's coming up next week. So no Fed speeches really, and not many ECB governors either. So really there's a lot of macro and a lot of earnings. Q4 earnings continue in earnest in the States. We've got a couple of big tech companies this week, including Microsoft, Tesla, Intel and IBM, and a bunch of industrials as well as some of the healthcare, some of the defensive stocks. They'll all be watched closely. Earnings, of course, critical. What's the outlook? What are CEOs saying about how they see the economy going from here? And then on top of that, a bunch of European and US macro data. A couple of the highlights include flash PMIs on Tuesday from across the globe. One of the first early takes on January activity as we get towards the end of the month. Then we got German IFO, Wednesday, we've got a bunch of US data, including first estimate of Q4 GDP in the back end of this week, and personal income and spending. So, as well as a couple of bits of US housing data, which are worth focusing on. So plenty of macro, plenty of earnings, despite Asia being largely closed this week. Lots to focus on in terms of price action. So that's it from us. That's our morning market hit for Monday, 23rd of January. Thank you for listening. Please do subscribe to these videos. Click on the subscribe button and do like and share on social media, or follow us on Twitter, LinkedIn and or Facebook. Thank you for listening. Stay safe. Trade well.